Today, we're going to talk about mortgages. Are they helpful or are they harmful? Hello, and welcome to the My Father Said podcast, where we discuss all things faith, finance, and family. I'm one of your hosts, Ryan. I'm both a father and a son.
Hey, everybody. I'm Robert. I am Ryan's father, and I, too, am my father's son.
And today, we are joined by a very special guest and longtime friend, Travis Walthall.
Hey, thank you for having me. Long-time listener, first-time guest.
There it is. There it is. So so take that to heart. If you listen, you might get on the podcast. There's no telling. It's a magical
like the Rush Limbaugh thing when they would call in long-time listener, first-time guest. Yeah. We need a sound thing to make a noise whenever he says something like that.
We do have a producer that could do that. Maybe not that one.
Yeah, I don't know if that's the right sound, but hey.
Regardless, we're happy to have you. That was a good one, though. Yeah. So Travis is a residential mortgage loan originator with Premier Nationwide Lending, and he is also a chaplain in the South Carolina Army National Guard.
Cool.
And we got Travis to come on today to talk with you guys just a little bit about mortgages and the real estate world and how that plays just a big piece into the financial pie. So with that, we will get into it. Travis, how long have you been doing this?
It will be 5 years in June.
5 years in June. And how did you get your start in this realm?
In which one, the chaplain or the mortgage?
Ooh, both. Let's do both.
Because they both happened about the same exact time. So I was interested in finance. As a matter of fact, Mr. Robert was my financial advisor before you suddenly came, and still questioning decisions here, sir.
Yeah, well, I'm sorry.
So is he.
But I was a blue-collar worker. I realized that I had a huge heart for ministry. I had a heart for finances as a tangible focus of ministry. So I began an education in finances. I got licensed in life insurance, and I tried to use that with financial planning and services, and realized, this is not the same thing, though it's a part of it. And as I would sit down, I started counseling people on financial security, just real credit crisis, like helping people in the church or something like that get their situations squared away, often just referring them to financial advisors or so on. But I realized that for many people, the single objective that they wanted to attain, at least like their first major objective, was buying their own home.
American dream, yeah.
So I was making no money with home insurance and realized, hey, this is let me increase my portfolio. So I got my license and realized that this is incredible. And I love this job. I love this field. Just as much as I appreciate finances for their tangible aspect of ministry, what is more, what shares the gospel more than providing a home for someone and helping that security? There's very few things. Adoption might be the only thing that is above that.
That's good. That's good. Cool. Okay. And correct me if I'm wrong. Premier Nationwide Lending, you didn't start out at that company, right?
I didn't. No.
Okay.
I was with a brokerage. So you can go one of two ways. You can go with a broker or a direct lender. Brokers might get you the better deal or the better rate, but there is a lot of uncertainty that can go with that. You might miss closing dates. You might get jerked around a little bit. It is not a guarantee. You get what you pay for. They're the cheaper option, and they're cheap.
Where have I heard that before? Where have I heard that? Yeah, cool.
Somebody said that.
I
don't know who said that.
Old and wise, really old.
Yeah.
Old. Emphasis on the old.
Yeah, probably.
And wise person.
So, Travis, let me ask a question here. So, obviously, as young people, and even people who are now married and all, as stated earlier, everybody wants to own a home. It might not come out and say that, but it beats living in a car. Okay, so everybody wants to buy a home. But of course, the question is, when is it the right time to buy a home? You know, I know that when I got married, I went out right out the gate and purchased a home right out the gate
For $150 78 years ago. You believe that?
exactly.
Back when a nickel was your full week's wage.
Yes, sirree. Yeah. Isn't it wonderful? I'm sitting next to these two yahoos. But anyway, so it's everybody's goal to get a home, but with the way prices are, the way inflation is, the way rates are, what's the dangers of waiting to buy versus doing it right now?
What are the dangers? Well, sir, you know, I've listened to the podcast for a while, and you often reference debt. What was it? Commodity debt, or what was it called?
Well, you got consumer debt.
Consumer debt.
Yeah.
Consumer debt. Renting a home is nothing but consumer debt. We don't think of it in that way because, you know, it's a month-to-month basis or a year's lease or whatnot. But renting is debt. And the only way out of that is either to live in your parents' house, which I know that you're full in support of.
Yeah, you love that.
You have not been listening to this.
Actually, you know, Travis just moved back in with his parents, believe it or not.
Oh, my God. This is going to take a turn for the worse.
Now, I think I'm more at that age where a parent might come live with me than the other way around. But with rent being, it is consumer debt. We don't think of it in the same way because it doesn't hit your debt to income ratio like that, but it is. Purchasing your home is the only true way to ensure that there is an end at some point, unless you just can save up money and buy in cash. But why would you do that? When a few weeks ago, y'all talked about a podcast of like the power of compound interest, and that the standard rate of return for the past 20 years was 9.8.
Somewhere around that number.
Somewhere around there. When interest rates were 3%, it was a no-brainer that you should go get a mortgage. It was like cheaper than inflation, with an end in sight. With interest rates where they currently are, even if home values, even with home values higher, because when you bought your house, when you came out of college, was it really worth what your home is valued at now?
No.
It's the exact same home, but the price is dramatically different.
Yeah.
That model isn't going to change. So what are the dangers of waiting? If you wait a year, you know, fluctuate. You wait 5 years, you're done. Like you've missed 5 years of equity. Think about the people who bought their home in, say, 2019, when interest rates were about 4.5%. They bought their home, and then all of a sudden COVID happened, and in South Carolina, the value of the homes doubled in what feels like overnight. It was actually over a couple of years, but it feels like overnight. If folks were like I knew a lot of millennials, even at that time, were just poking the bubble with a stick, hoping it was going to pop. But in reality, their vision was too narrow. They were still too burned from the recession that happened in 2008, still just too fresh, and they were scared. And their fear, they're trying to time the market.
Can't do it. Yeah.
It bit them. So now interest rates are higher, and the cost of the homes are higher. And it's anyone's guess. No one can guarantee. But the likelihood of that changing is not very high, and there are reasons for that.
Yeah, I see that. We, just last year, my wife and I purchased a beach home, and I'm looking at the value of it today, 1 year later. The sale price that's being suggested for it has been a pretty noticeable uptick in value. So that has caught my eye. So I see a little bit of what you're talking about there.
It's interesting how I think it was y'all's podcast that mentioned that when the was it 6 or 7 of the best days were during the market downticks.
Oh yeah.
Right. That's no different in the housing market. Some of the best times to buy, what would confuse many people is during COVID and like the crazy low interest rates, that was a seller's market. 100% a seller's market. People were buying with low interest rates, and that's amazing. We want people to buy with low interest rates. Keeps their their monthly payments low. But they were buying these homes, and they were getting no money from sellers and seller concessions. They were waiving appraisal, like the appraisal waivers. They were putting 20, 30. I saw one that was $60,000 over asking price.
Yeah.
Sight unseen. Because it was just this crazy market, and they couldn't get the affordable homes. Well, now it is not a seller's market. This is a buyer's market currently. What is today? The 23rd of May, 2024. This is a buyer's market. And that means that there are more sellers than buyers. It's not the best buyer's market to ever hit, but it is a buyer's market where sellers are contributing. My last 3 deals that I've closed, the sellers contributed $10,000, $10,000, and $9,000 in closing costs.
Wow. Yeah.
And all of the homes still appraised over value. So they're buying homes with equity in them, and they're buying them with the seller bringing money for closing. So it's not a bad time to buy.
Cool.
If you can afford it.
Cool. Cool. You made a comment earlier. You said that rent is basically consumer debt.
100%.
Yeah, I've never heard that before, but that's a really good way of putting it. But then you also said it's different than consumer debt because it doesn't hit your debt to income. Talk to us a little bit about debt to income, what that is, how that affects us.
So many people believe that they have to wait to purchase a home because they don't have enough money for a down payment. But if you're buying your first home, you probably don't need a 20% down payment. As a matter of fact, I would probably counsel people away from putting 20% on their first home. What really matters is your debt to income ratio. The way that we derive your debt to income ratio is we take your minimum monthly payments on all of your debts, and then we take your mortgage payment, we divide it by your income, and we determine that percentage. And the truth is, if you want the best interest rates, your debt to income ratio needs to be like 20%. And the more your debt, like the higher your debt to income ratio is, the worse that's going to go for your either approval process or your interest rates. So debt to income ratio is something that we desperately care about. And if you ask, and it is for this reason that a financial advisor, an accountant, and a loan officer are going to give you 3 different views for advice, like financial advice, right? I've seen it before. I think we were talking about this, where I've had clients that make easily, they're business owners, small business owners, sole proprietorship. They make $140,000 a year. Clearly, just in pure profit, they make $140,000 a year. But their accountants are so brilliant that it shows they make nothing.
Yeah.
And so I can't get them approved because their accountants are just too savvy at their job. So they save money on taxes, but they haven't set themselves up with a good debt to income ratio. So having an amazing partnership between the accountant, the financial advisor, and the mortgage loan officer is crucial in understanding, hey, how can we all work together to help the consumer achieve their goals?
Yeah, and that's something that we have said on this podcast multiple times, is having a group of advisors to surround yourself with, and then keeping everybody in the loop and talking about it, so that you're not just pigeonholed into one thing. You've got multiple professionals talking about it. It's cool.
Yeah, I think I just heard Travis say something very similar to, I want to make sure I get this right. CPAs are so good at their jobs that the individual he's speaking to shows no income being made. I think, Travis, you may have just caught the IRS's attention. And when you get back to your office, there's going to be a guy there with a briefcase and a suitcase. Good. And they're going to be camped out at your office for a while. Now that I think, what I think I just heard. I want to make sure that the IRS knows he is in Charleston. He is not here.
He is not in this office.
Exactly.
We don't know anybody that doesn't make any income. That's
exactly
like father, like son. Just throw you under the bus. Got it. Yeah. All right. Know where Ethan gets it from.
Yeah. Exactly.
Oh my. Okay.
I don't know if you know that, but your son is notorious for throwing his friends under the bus. The closer the friend, the more
Yeah,
often you get hit by tires.
Nope.
Well, I think you were the one that tried to cut his foot off, though, wasn't you?
No,
That
he
is-
cut it. No, I'm the one that got him to the hospital.
But it was your sword.
He dropped it on his own foot.
You gave it to him. You know he's clumsy.
That is true. That is true. Would you give your son a sword? No. Well, maybe.
Ryan, have you met me? Hi, I'm Travis. I have swords.
That's good. Why didn't we put that in the intro? He's a chaplain and a sword enthusiast.
Yeah.
Now, you made a comment, though, the debt-to-income ratio. You said you want it around 20%?
No, well, for the best bang for your buck, right? Your mortgage, no matter what, you're going to have a debt-to-income ratio when you get a mortgage because the mortgage itself is debt. So it's going to hit you. Ideally, like the best rates are going to be 20%, 25% debt-to-income ratio. Anything under that isn't really going to affect your rate much.
Oh, okay.
But when you get into the 30s, 35%, all right, your rate is now affected. And then when you get into the 40s and 50s, now not only is your rate affected, but your approval is going to be affected.
Okay.
So there are several, especially like government loans, that limit the debt-to-income ratio. It can only meet a certain threshold. It's almost guaranteed. It's almost guaranteed. There are exceptions that if you have a DTI above 55%, you're likely not to get the loan.
Okay.
There are mitigating circumstances with that. If you have, $300,000 or $400,000 in investments or in assets,
Sure.
that offsets the risk, and they're mitigating circumstances.
Cool. Cool. All right. So us being financial advisors and we're wanting individuals to save for retirement, keep their debt down, and things like that. Some questions we get here are, hey, should I do a 15-year term or should I do a 30-year term on the loan? Any insight on that?
Absolutely. It really comes down to the age of the individual. So any advice or insight that I would offer is going to be determined on the age of the individual. If you are 21 years old and you are buying your very first house, and let's say you're not married, so you're just buying a house to live in, maybe it's going to be a 2-bed, 1-bathroom. The likelihood of you living in that house long term is low. And the likelihood of you making an income that can pay off a 15-year loan is lower. So if you are, the general rule of thumb that I play by is if you're buying your very first home and you are under the age of 40, you probably want to go with a 30-year loan because you can still pay it off at a 15-year rate.
Oh, yeah, yeah.
You're not locked into that, but should something happen, you can draw from the extra payments you're making. The folks that I would encourage to go with a 15-year loan are those who have owned a home before. They're selling their old home. They're rolling the equity into their next home. And they don't want to reset the clock. They want to continue. And the interest rate for a 15-year loan usually, not always, but usually is slightly better than a 30-year rate. And it's not going to be so dramatic that it's oh, you're saving a crazy amount of money, but it's usually better on a 15-year loan. Okay. So for those folks, what they're really doing is they're maintaining the same payment that they had before, and they're maintaining the same amount, like the term. They've lived in their home for 15 years. They just sold it. Now they have that 15 years left. Never want to reset somebody back to zero. Sure. Unless we have to.
All right. That brought up a good question. You said, hey, you can get a 30-year term and then still pay it off over the course of 15 years.
Oh, yeah.
In South Carolina, is there any prepayment penalty, or is that specific to loans or anything like that?
There is no South Carolina regulation for prepayment penalties. It is going to be specific to loan programs.
Okay.
There are loan programs that, like the VA loan, there's no prepayment penalty with a VA loan. USDA loans usually don't have a prepayment penalty. Prepayment penalties are going to be seen in conventional products and non-qualified mortgages, so like investor-type loans.
Okay. Cool.
Okay. So, in speaking of the 15-year and the 30-year loan, there's obviously different types of loans available. You got these balloons, you got these ARMs with a certain period of time on them. How does a person looking to buy their home, how do they determine what is the applicable loan for them?
They use a loan officer.
Do you know one?
Well, that's a good answer.
That is. All right, next question.
That is a very good answer. That's the simplest question.
That's really good.
So it's interesting. Most people can handle their financial portfolio on their own if they want to. Like, they can manage it themselves if they want to. Most people can represent themselves as like a real estate agent. Like, they don't have to use a real estate agent in a transaction. They can represent themselves. I don't know of many individuals that can loan themselves money. Now, that's not to say, like, I've heard of it.
Met my wife. In fact, I think that's one of the biggest problems with the American consumer today is they have figured out how to loan themselves money. They might not call it that, but I think that's one of the biggest problems.
Credit cards.
Yeah.
Well, even credit cards is someone else loaning them money.
That's true. Yeah. Yeah. At a 16% interest rate.
Yeah. So when I say loan themselves money, it's someone who has, a tremendous amount of assets that can draw from those assets as a loan. So there are products like that. I'm sure y'all are the experts in that.
But what about those commercials on the credit cards where it says if you have more than $10,000 in debt, you are entitled to loan elimination things? I mean, what about that?
Eliminated by whom? Who pays for it? Who takes the hit? Somebody's taking a hit.
Taxpayers.
Not according to our political leaders. I mean, it just
Taxpayers.
vanishes. It like poof in the air. And see, you're getting ready to put me on a soapbox. And I don't want to get on a soapbox. After last week, I don't want to get on a soapbox.
I kind of want to see it.
No,
I heard about it. I want to see it.
No, you don't.
So taxes. I heard you're really in favor of that.
Yeah.
Hey, you want to know something that is going to really make you frustrated?
Oh, gosh.
So they're called LLPAs. It's effectively, dumbing it down, government fees to the borrower to originate the loan and servicer. So what determines your interest rate is part of that determination is based upon the fees that the government will charge. Well, last year, the LLPAs were increased specifically for borrowers who were bringing 20% down.
Oh my gosh.
And had credit scores above a certain threshold. So the better your credit,
Above,
they are now subsidizing. So
Oh, yeah.
Mr. Robert, people with credit scores that are 800 who are bringing 20% down on their mortgage will get a worse interest rate than people with a 680 credit score and 5% down payment. Because the better qualified borrowers are now subsidizing the underqualified borrowers.
there's another reason why it's so important for you to encourage your children to be dummies. I almost said a bad word. But there's another reason to encourage them to be blights on society so that they just sit around, do nothing, hold their hands out, and expect those people who carry not only their own weight, but your weight as well to, God almighty.
Got him.
Oh, my gosh.
Oh, man, that's good.
These political leaders are bent and determined to just drive this country down the sewer as far as they can do it. All just to buy a vote. And the people out there who are embracing these things have no idea that they are dependent on your stupidity to continue to vote them in office so they can make you more dependent on their stupidity. It's just a vicious circle that goes round and around. And yet, it's the rich people that get all the breaks. Well, the reason for it is because you want to stay stupid. I said I wasn't going to do this today.
All right, well, with that, we'll move on to the next question. Travis, I know this is kind of a loaded question.
Why don't you go back to Charleston?
He's going to associate high interest rates now and mortgages with you, just in a negative light.
Your voting matters.
Your voting matters.
Your voting affects your pocketbook.
That's good. That's good. What are your thoughts on the interest rates right now? Are they high? Are they low? Do you think they're going to change? Just talk to us about rates.
Historically, these rates are the average. So if you're tuning in with us, what we saw between 2020 and June of 2022 was a historic low over a 100-year time span. Rates had never been that low before. So if you're basing your understanding on what rates should be off of that time period, then I'm going to encourage you to zoom out and take a broader perspective. The truth of the matter is 7% is the average interest rate over the last 100 years.
Wow.
And they got really, really high. I think it was back in the 80s was like the highest I saw was like 19%. And that was for qualified borrowers. That wasn't like the folks struggling with their credit as we used to determine interest rates. So the things that have really changed, it's not the interest rates, it's the cost of housing. So what are my thoughts on these rates? The volatility that we've seen in the past 2 years is unusual. There's always volatility in the market. There's always going to be changes in the rates up and down. But the dramatic shifts that we've seen, like how often do we have global crises that shut the world down? That's my thoughts on rates. I'm actually kind of glad where they are.
I think right now we can kind of cynically expect them to come every 4 years.
Yeah.
At this point.
We got the bird flu now,
there's
right?
a bird flu or
flu
something
coming
out
on.
there now that we're talking about mail-in ballots again. So, yeah, I think precedent has been set. I think it's probably going to be about every 4 years. So if bird flu happens and it shuts things down, I expect mortgage rates to fall because you said they were. Right? And then I'm going to go out and borrow a bunch of money and just, enjoy it.
You should, sir. Go do that.
Thank you.
Go
Thank you,
do
Travis.
that.
Thank you so
and
much.
if you need a lender, I've got you.
I understand you do.
Oh,
My
man.
credit score is good, although I'm going to be subsidizing people who are lazy and won't work.
Well, you can fix that. Just bring less money to the table and go get a bunch of car loans and a bunch of other stuff.
Tank your credit score and
You can-
have no money.
Yeah.
You can buy that pool on credit that mom's been asking you about
And not pay for it.
and not pay for it.
Yes. The American way.
The idea,
God bless America.
Yeah.
the idea behind it is to help people who are struggling. But as we all know, when the government gets involved with subsidizing the poor, it doesn't work. Jesus said the poor you will always have with you. Like, subsidizing poverty only increases poverty.
That'll preach. My gosh.
Oh,
that-
There's the faith part of it. He is an ordained minister.
Yes,
I mean,
sirree. Where is the offering plate? I mean, my gosh, that is great right there. That's good stuff. Okay, so what is, since we're on this topic about bird flu and stuff like that, and of course, things are cyclical in the market. We know things are cyclical. If it's come around once, it'll come around again. And so market crashes. What exactly, Travis, would be the layman's definition of a housing crash?
Home values tank, buyers can't get approved, and the market, as it were, stalls. So in June of 2022, we saw interest rates begin to dramatically increase. So they were already on the uptick that year, but by June 2022, they went from around 4% to, by the end of the summer, they were 8%. And what that did was, I actually would consider that a market crash in the housing market. It was. When homes were increasing in value, at least in the Charleston market, in South Carolina as a whole, I can't speak to the rest of the country, but the average home price at a certain point was like 20% every month. Home values were increasing, dramatically every month, every year. And when June of 2022 happened, that put a halt to that escalation of appreciation. That halt was so dramatic that between June of 2022 and today, 63% of loan originators, folks who do what I do, have not renewed their license and have left the business. 2/3 of an industry are no longer in that career path. That is a market crash.
Wow.
So, if we heard you right, we had a market crash back in 22.
That's correct. Those millennials that were waiting for the bubble to pop,
It already happened.
it happened. This is the result. What we're now in, and you're asking me, where do I hope interest rates to be? I actually don't want them to go up, and I don't want them to go down.
Okay.
I want them to find a general sense of stabilization, just long enough for us to, I hate the term because it comes from COVID, but a new normal. Let us get adjusted to how this is. Let our economy kind of work itself through with inflation. This is the first time in my lifetime that the cost of living in South Carolina has caught up with the rest of the country.
Yeah.
Let us get used to it.
Yeah. That's kind of sad, though, when you think about it. So how often does a housing crash, how often do they come around, historically speaking?
Routinely. Pretty regularly. They used to be a little bit more distant. So about once every 15 years was an average. And then obviously there were some gaps, maybe not obviously to other people, but you just go look. There were some gaps where, okay, it was about a 20-year span, and then there was a massive crash. And this isn't to say a crash and when the market goes down, those aren't the same thing. Dramatic shifts are crashes.
Okay.
And they are usually more spaced out than what we've seen in the past 25 years.
So in the past 25 years, we've had how many market crashes based off of your
in
industry?
South Carolina?
Yeah.
It really depends on if you want to include when the textile industry left South Carolina.
Sure.
So if we want to back it up to like 30 years, 3.
3. Okay.
So what used to be
one every
15 years
decade.
is about one every decade.
Okay. All right. Good deal. All right.
Okay. Another question we got for you. Private mortgage insurance. People have heard of that, don't know what it is. Can you talk to us about what PMI is, how much it costs, and can people get rid of it?
Premium mortgage insurance, private mortgage insurance. For FHA loans, it's called MIP. In the VA loan, it's a guarantee fee that you pay up front, or the funding fee. USDA is a guarantee fee. All of these are insurance payment to offset the risk of the borrower. Now, why do you want the risk to be offset?
You tell me, Mr.
Now-
Officer.
Well, Ryan,
It depends on if I'm the lender or the buyer, I think.
Yeah, it depends.
theoretically, I wish it was always the case. I wish it was a 1-for-1, but theoretically, with a reduction of risk comes a reduction of cost. So anytime you have insurance, the more risk, the more your premium. In this instance, having premium mortgage insurance on your loan reduces your risk, which then allows the lender to reduce your interest rate.
Does debt to income
That also-
ratio is
Yep.
involved in that?
Yes.
Okay.
So the more assets you have, the better your credit score, the more your down payment is, the less risky you're likely to default on that loan. The less risk there is, the more we can give you a better interest rate. The more risky the loan is to default, the higher your interest rate is going to be, theoretically, and then the government gets involved.
So the insurance is there to protect the lender, not the borrower, correct?
It's there for mutually beneficial. It's a symbiotic relationship. Yes, it is 100% a soul-sucking creature that does nothing but increase your mortgage payment. But realistically, it's the reason your rate's where it is.
Okay.
And it is possible to get rid of it. Well, with certain loans. FHA loans, They have MIP for the entirety of the loan, and it's set at a very specific rate that is not determined on your credit score.
Okay.
USDA is the same way. It's there for the entirety of the loan, not determined on your credit score. VA doesn't have it because you fund it all up front.
Okay.
And there are ways to get that waived. Like disabled veterans, their funding fee is waived. I'm a VA mortgage expert. So if you have a VA loan, hey, I'm your home loan chap. Yeah, I did a little plug.
Yeah, that's okay. So I was listening to you talk a while ago, and you took me to a visual. So I can imagine being the married couple sitting at your desk when you say to them, here, I need you to endorse this document. This is a soul-sucking creature, but it's for your own good. Mm-hmm. Here, sign this. I'm not sure that's a good way to get a person to sign the document, but I understand you. I understand what you're saying.
What would you call a surgeon if not a sadist who enjoys inflicting pain on others?
I'd probably just call him a surgeon.
Oh, I got it. My bad.
It depends on if it's before or after the surgery.
Yeah. Am I out or am I not out? Yeah.
It's like a lawyer. It's like a lawyer. No one likes them, but when you need them, they're beneficial.
Oh yeah, yeah.
It's good.
That's good stuff. That's good stuff.
Well, I've got one last question for you, Travis. But before I ask that question, because it doesn't have anything to do with mortgages, any parting thoughts or wisdom or insights that you'd like to leave the listeners?
Actually, I do. Okay. Surprisingly, so and it's for Mr. Robert, and it's just a thank you. I don't know if I've ever told you. So I've known Mr. Robert for a very long time. His oldest son, Ethan, was the best man in my wedding, and you may not realize this, but you've discipled me. I don't come from wealth. I come from extreme poverty. Matter of fact, my very first deal that I ever did was I helped my dad buy his first house at 60 years old.
Oh, wow.
Because I was the first person in my family to graduate college, first person to join the military as an officer, first to buy a home. And I was able to take that and turn it around. So what I had to do was find men that I respected, that were where I wanted to be and who I wanted to be. And you didn't necessarily disciple me directly, but your son is one of my closest friends. And he has had a tremendous, and I hate saying this because I love to tease him, but he's had a tremendous impact on the man that I've become and developed. And as a matter of fact, I have a son. And when I think of how I want to raise my son, I think about how you've raised Ryan and Ethan. So you've discipled me along the way, sir.
Well, thank you. I appreciate that. But you tried to cut my son's foot off.
I got him to the hospital.
I don't believe this.
Thank you for all that you did. It's meant a lot. I'm going to try and cut your son's foot off.
I'm going to amputate his foot.
He still doesn't have feelings.
I am. I'm glad you like my son. My
Like is a strong term.
Could you imagine if he didn't like you?
Run, Ethan. Run fast.
That's good.
He was in another room playing with the sword and dropped it on his own foot. And then just looked up and was like, hey, and kept talking with me as though he didn't. Just almost sever his little toe. Like, matter of fact, when he told me, my first thought wasn't for his concern. It was, did you damage my sword? Like, because he dropped it on tile.
That's good. That's real good.
Oh, all right. Well, with that, last question for you. What is the single best piece of advice you have ever gotten from your dad?
It was 2 weeks before my son was born. And I started to stress, am I going to like him? Am I going to be a good dad? Am I going to be able to afford it? And whereas I can't call my dad for many bits of advice because I've had to look elsewhere for it. Now, my dad is a wonderful man, and we have an amazing relationship. But we all recognize that there are areas of development. So I called him up, and I was just concerned. I was like, Dad, you've had 4 kids. How'd you do it? And I told him what our frustrations were, and he goes, son, don't worry about it. And at first, I thought that was the worst bit of advice that you could possibly offer someone in my situation. And then he broke it down, and he referenced Matthew 6. Don't worry about tomorrow. There are enough worries of today. And he reminded me that my faith and my confidence aren't in myself. They're in a heavenly Father who is always faithful. So don't worry about it. That was the best bit of advice my dad's ever given me.
That's good. That's good.
Very good advice.
Yeah, there's a couple of things that you could use in here in your next sermon. So that's good.
Absolutely. The fella who chopped off my son's foot said, "Don't worry about it.
Don't worry about it, Ethan. Don't worry about it. Tomorrow's got plenty of problems."
You know what we're going to have to do? You have referred to your brother many times on these podcasts, and now you've got a guest coming in.
Yeah.
We're going to have to get your brother in here to defend himself.
I don't think we should. I think we should just let this go for
Absolutely.
years and
Yes.
years and years.
Let him be the redheaded stepchild that never appears, and he deserves it.
Oh my gosh. And this is the guy who is the best man in your wedding. God. All right, guys. Well, this has been another episode of the My Father Said podcast. We are so glad to have Travis on here with you. We'll have his contact information put out at the end of the podcast for you to look at if you want to give him a call, see if he can help you out. I'm Robert. I'm Ryan's dad.
I'm Ryan. I'm Robert's son. This has been the My Father Said podcast, and we will see you guys next time.
Later.
The opinions voiced in this video are for general information only and are not specific advice or recommendations for any individual. All performance reference is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.